welcome everyone to this week's Insignio Speaker Series. I'm very happy to be joined today by Richard Bernstein. Richard's joining us from New York with a New York Rangers jersey behind him, but we won't hold it against him, even though he's talking to someone in South Florida. For those of you who may not know, there's a current series going on in the National Hockey League, the Eastern Conference Finals between the Florida Panthers and the New York Rangers, which are tied. Richard, how are you? Thank you for joining us today.
Yeah, no, thanks for the invitation. Great to be with all of you.
Richard, so maybe for those of you who don't know or are not familiar with you or your work, can you give us a little bit of background of who you are and a little bit about your firm, RBA?
Of course. So I was, prior to forming RBA in 2009, I was at Merrill Lynch. I spent 20 years at Merrill Lynch, and my final position there was as the firm's Chief Investment Strategist. And I left there in 2009. Formed RBA. We're now around for about 15 years, manage about $15+ billion in assets. Importantly, we are a macro firm. What does that mean? That means we know nothing about Coke versus Pepsi. We drive the performance of our portfolios not through individual stock selection, but rather through macroeconomic considerations. That may be growth or value, large and small, geography, quality on the bond side, duration on the bond side, things like that. But it's all macroeconomically driven. Importantly, one final thing, we're not event driven. You know, most macro firms are very event driven. What's the Fed doing today? What's the reaction of the market? You know, very here and now. We're very fundamentally driven. And because we follow fundamentals so closely, we're a little bit slower than the typical macro hedge fund or something like that. We're long only, and we're very fundamental, very slow process because the macroeconomy just doesn't change that dramatically that quickly.
Well, Richard, so you're speaking straight to our heart here. I'm a macroeconomist, and we follow this approach as well, top-down approach from the CIO office. But let's talk about your process specifically, because people didn't come here to hear about me. They want to hear about you. Mm-hmm. You know, people who are doing top down, they tend to follow either economic cycles or profit cycles. Mm-hmm. Which one do you tend to adhere to? Maybe both. Maybe talk to us about how you balance those two.
Sure. So, you know, in the early 1990s, we did some, not patting myself on the back, but it was kind of groundbreaking research that tried to investigate what were the macroeconomic influences on things like growth and value, large and small. Like everybody knew they existed 30, 40 years ago, but nobody had tried to figure out why do you get the rotations between growth and value, large and small, or quality or things like that. And so we set out to try and find out what that was all about. And what we found was that all these rotations among various segments of the equity market are very much influenced by the profit cycle, much more so than the economic cycle. And this kind of gets to the heart and soul of equity investing. You know, people forget, we tend to think of the equity market as a horse race, but that's not really what it's all about. It's, you know, when you buy equity, you become a partial owner of that company. And as a partial owner of the company, all you really care about is the profitability of the company that you own. Right? You don't really care about GDP. So in that light, it makes sense that profit cycles would be so important. Economic cycles obviously influence profit cycles, but so do a lot of different things influence profit cycles. And so people very often ask, well, what's the difference between a profit cycle and an economic cycle? Number one, profit cycles tend to boom and bust. You know, we should all be very grateful that doesn't happen in the overall economy, that we don't boom and bust. And number two, they happen much more frequently. You can get many profit cycles within one economic cycle. So in a kind of scientific sense, the periodicity is shorter. So you get a lot of shorter profit cycles within one economic cycle.
Great. So talk to us about right now, where do you think we are in the profit cycle? And maybe if you care to share your thoughts about where you think we are in the economic cycle as well.
Sure. So let's talk about the economic cycle first. I think that economists continue to be surprised at sort of the resilience of the economy. I love that word resilience, because that usually means that people didn't expect it to be strong and it turned out to be strong. So they say, oh, wow, it's resilient. And but I think that's the appropriate word to use here. You go back a year ago, and I think it was 90% of economists were saying that a recession was very likely. Of course, we didn't get one. And I think the reason we did not get a recession was two things. Number one, during the pandemic, money growth in the United States peaked at about 27%. That was over two times the fastest money growth ever in modern U.S. history. And I think that what economists had no history to base this on, but with 27% money growth, it's pretty clear now that it takes more than 525 basis points of rate hikes from the Fed to negate 27% money growth. And so we saw the lingering ongoing effects of all that money growth and how that ripples through the economy. On top of that, one has to remember we had a massive fiscal stimulus package towards the end of the Trump administration. We then had another one at the beginning of the Biden administration. And so
yet another one.
And then we had another one. So it's like we've got all this massive fiscal stimulus on top of massive monetary stimulus that just doesn't go away in a year or two, right? And so we're still feeling that effect. And so I think the economy has has continued to positively surprise.
Yeah. So let's talk about some of that, because we've been hearing some mixed messages from the companies during the earnings call, the recent earnings seasons. We've heard some companies like Walmart, Costco, Target, and others say that they're having a harder time passing on cost increases to consumers, that they're seeing consumers sort of spending down, right? People who might have shopped at Target are now shopping at Walmart and so forth. So you're seeing some squeeze on the consumer side, but then the banks are saying that their flow and their loan appetite seems okay. What's the message that you've taken from the current earnings season?
Right. So the way I look at it is that you got to remember, in every cycle, not all 8 cylinders of the economy are ever hitting at the same time. Right. I mean, that's like an amazing booming economy. And rarely does the United States experience that kind of booming economy anymore, where you get all 8 cylinders pumping right at the same time in perfect tune. Not the way it works. And so what's happening is you're seeing little pockets of weakness here, but then you see little pockets of strength here, weakness here, strength, little things like that. And that's perfectly normal, by the way. And of course, these days, when anything is, abnormally positive or negative, it's either the economy's booming or the economy's dying, right? There's nothing in between anymore, the way people describe everything. So we have to understand that. Number two, with respect to the consumer, which is obviously the largest part of the economy in the United States, employment's going to be the key to what to how they act and what happens with consumption, right? On the simple grounds that if you have a job, you buy something that you didn't buy when you didn't have a job, or if you lose your job, you stop buying something that when you had the job, right? It's just very simple economics. The labor markets are still extraordinarily tight. They're not as tight as they were immediately post-pandemic. Of course, that was very unusual. But relative to history, the labor markets are still amazingly tight. Wages are still growing, not at the same clip they were immediately post-pandemic, but they are growing. And the consumer overall, that part of the household cash flow story still looks to be good. When the consumer really runs into trouble is when the household cash flow story gets very shaky. In other words, people start losing their jobs. Mm-hmm. And if you don't have any income, that's when the whole thing starts falling apart. That's when you really start defaulting. That's when you stop buying things, right? The whole economy starts imploding when that happens. So far, there's I won't say no indication of that. There's scant indication of that at all.
Okay. And I'd like to remind everyone that if you do have a question for Richard, please put it in the chat, and I'll be happy to read them out loud to him here in just a few more minutes. Richard, let me ask you two things before we move on to how you're currently positioned in your portfolios, what sectors or regions or countries you're overweighting and underweighting. Let's hone in on two finer points on the U.S. economy. Let's talk about the labor market. You're right; it's still tight. It's not as tight as it once was. There's some evidence that a lot of that tightness in the labor market has been due to the supply side and the supply of labor, which has been meaningfully higher than most economists expected because of the surge in immigration, both legal and illegal immigration. But we have seen some weakness on the demand side for labor. Are you concerned with the labor demand weakness that you're seeing?
Well, it's interesting, Ahmed, that almost all economic indicators have seen increased volatility post-pandemic.
Sure.
It's pretty wild. I don't think if you look at any data series, economic data series, it moves along, and all of a sudden the pandemic comes and the volatility just spikes. It's just incredible. And so the labor market data is showing that too, to some extent. And so, yeah, we have seen some fall off in labor demand, the number of open jobs and things like that we have seen, but still relative to history, if you look at unemployed people or number of open jobs relative to the number of unemployed people, we're still pretty tight. That would argue that there's still some demand for workers. And, anecdotally, you're still seeing some of this, I'm not saying this is good or bad, don't misunderstand, but you are seeing more union organizations and things like that, because unions tend to form when the labor market's tight, because everybody thinks they can stick it to the man, right? You're not going to form a union if you're worried about losing your job. And so, this week we saw the Disney characters decide that it was time to unionize. I mean, my joke was that when my daughter was little, we used to take her to Princesses on Ice. Now we get to look for Princesses on Strike. That's kind of the difference of what's going on right now. And, but I think, look, the labor market's definitely not as tight as it was, but it's relative to history. It's still pretty tight. Yeah.
Okay. And then finally, before we move on to your current portfolio, the consumer, there's a sense that, there's been an increase in buy now, pay later, some shadow banking. Are you concerned that perhaps the current state of the U.S. consumer, given what we've heard from places like Walmart and Target and others, is perhaps not as strong as some of the more classical economic indicators are suggesting that they are?
Yeah, it's interesting. There is definitely, financial risk in the consumer sector. There's no doubt about that. And I always point out to people that, no matter how much you want to regulate the financial sector will always find a way to get around the regulations, right? That's the story of Wall Street. We always seem to blow up. We always seem to find some new thing to exploit. And that's just the nature of the beast. And that it is what it is. And I think, you may set up consumer protections, but then we're going to find a way to get around that and go in the back door. And I think that's exactly what's happening. I think your point's very well taken. That kind of risk has not been ameliorated in the economy. I do think, however, if you look at two things that I would point to here, one is consumer confidence itself. There is some aspect that is saying that everybody thinks they're okay and somebody else is suffering, right? And there's a little bit in the data that's beginning to show that up, and I'm not quite sure why that's the case. I really don't know, but it's kind of interesting that it is showing up. And the second thing I would point to is that the leading indicators of the U.S. economy, both the Conference Board and the OECD version, have troughed and they're beginning to head up. Now, they're still, in absolute terms, they're still negative, but they've actually troughed and they're starting to turn up and things are getting better. And I think that bodes well for a lot of the cash flow and debt issues, both on the corporate side and on the consumer side, that if the economy gets stronger, some of those issues will subside. Now, if the economy gets weaker, I think your point becomes a massive point, because there's like this hidden borrowing in different parts. And that usually, debt events usually occur when either corporate or household cash flow turns down. When that happens, then I think there's going to be some very interesting problems.
Okay, great. So now let's discuss your current portfolio positioning. How are you positioned? Where are you on rates, on equities, geographically? Give us a sort of big 30,000 foot view of your current portfolio.
So I mentioned before, Amit, that we spend a lot of time looking at profit cycles. And so for us, what's going on in corporate profits? In the United States right now, corporate profits are revving up. There is no doubt about that. Corporate profits growth in 2023 troughed at about minus 15% growth. It's our forecast by the end of this year, it'll be about plus 15%. So going from minus 15 to plus 15. And that's showing up. In the United States right now, there are over 170 companies growing earnings 25% or more right now. That's just in the S&P 500.
So it's not just a story of the Magnificent.
No. In
or
fact,
formerly Magnificent Seven,
yeah,
then five, and now maybe even two or three, right? So
right. That's to us at RBA, that's been very confusing. Like, why have people focused on 7 companies when there's 170 plus that are growing earnings 25% or more? That's normal, by the way. Profit cycle troughs, the number of companies growing earnings rapidly goes up. And that's what's happening. I think what's less known is that this is not just a US event. You can look around the world. Emerging market profit cycle is turning up. In the United States, small cap profit cycle is starting to turn up. I mean, you can see in many, many different parts of the world now that corporate profits are starting to improve. Now, if you want to be a cynic or a skeptic, whatever the right word is there, you would say, well, it's just easy comparisons. And of course, that's true. But every cycle starts with easy comparisons, right? You can't start with hard comparisons. So this is much more normal than people think. And, to your point, why are people so fascinated about the Magnificent Seven? That's a real tough one, given that the growth environment is improving. The profits growth environment is improving. So how are we positioned for that? Well, I always point out the cycle by definition is determined by cyclicals, right? Stable companies are stable companies. They don't cause a cycle. So in the United States, we're going from minus 15 to plus 15. You can guess how we're structured. Our portfolios are overweight energy, materials, industrials, mid and small cap stocks. I mentioned the global profit cycle. So of course, we're overweight emerging markets, right? You can see where we're going here. We're trying to grab that cyclicality in corporate profits any place we can. But so I think if somebody were to just look at our portfolio right now, they would actually laugh a little bit. Because they'd say, wow, you're really underweight the Magnificent Seven and you're overweight everything else. And the answer would be, that's exactly right. That is how our portfolios are positioned. I don't think anybody needs somebody else to tell them about NVIDIA or Microsoft or Apple. And if they did, we wouldn't be the right people for that anyhow. But I can tell you the fundamentals in other parts of the market are being completely overlooked. And we think this is a tremendous opportunity.
So you mentioned one grouping there that I would like to hone in on, the small caps. By every metric, they're cheap versus large versus mid. I mean, versus pretty much against their historically cheap valuations. But this has been now a 10, 15-year story with small caps, right? What about them right now is different than what it was? I mean, because they were cheap 5 years ago, they were cheap
absolutely.
10 years ago, right? So they've been cheap for a long time. What is it about them right now that tells you, hey, now's the time to go overweight small caps?
Right. And to some extent, if you think about it, the fundamentals argued that they shouldn't do as well. Their relative earnings were not doing well for the majority, not necessarily 10 or 15 years ago, but when I think they outperformed, but certainly in the last 5, 6, 7 years, their relative earnings have been inferior and therefore they underperform. And I think everybody knows that valuation alone isn't a very good stock selection criteria. I mean, in the long term, of course.
I was going to say it's a great long-term predictor,
right.
But in the short term, things can get a lot cheaper.
Or it doesn't mean anything,
right?
Right?
So, yeah.
It doesn't mean anything. And so what's the story? What's the catalyst, if you will? Every value story needs a catalyst. What's the catalyst? The catalyst here is basically that relative earnings are starting to turn up. Mm-hmm. Right? Mid cap earnings have already turned. Small cap earnings are starting to turn. As I said before, you now have 170 companies growing earnings 25% or more. The earnings story is starting to broaden. I think that's really the important point. In English, it's that there's more than 7 growth stories.
Okay, great. So Richard, now I'm going to turn it to some questions that I've received here. But before I do that, why don't you tell the folks, if they're interested in your strategy, in your thinking and accessing it, how can they implement that at the securities level?
Absolutely. So in the United States, I'll start there in case somebody's in the United States. In the United States, we offer separate managed accounts on numerous platforms, including the one that we're talking about right now. We have mutual funds. We have UITs. We have one ETF on the American Industrial Renaissance, which is a long-term story about the reindustrialization of the American economy. There's many different ways to access us, as well as many of our portfolios are now available in UCITS forms, which is great if you happen to be offshore. So we now offer many of them. Not all of them, but many of them are offered in a UCITS form, also available on this platform that we're all on right now.
So before I jump to these questions, thank you for that. Before I jump to these questions, let me ask you to hone in on the American reindustrialization ETF. That's one that I think we've actually talked about here, in the sense that the U.S. government has all of a sudden realized, oh, maybe it's not such a great idea to make everything abroad and cheaper. Maybe we'll make it over here, even though it's a little bit more expensive. That's a trade-off that we're willing to do. Talk to us a little bit about that strategy and what's sort of the thinking or the themes behind it.
Sure. It's a very simple construct. I mean, it's sort of the stuff that's staring us in the face and people just don't recognize it yet. So number one, we know that the globalization is contracting, or the deglobalization has begun. You see it in Eastern Europe. You see it in the Middle East. You see it in our relationship with China. You see it in Latin America, different parts of Latin America. You're seeing it now. And you're certainly seeing it in Africa, different parts of Africa as well. So we know that globalization, which has historically expanded and contracted like an accordion, is starting to contract. That's number one. Number two is that as this accordion is starting to contract, one has to realize the United States now has a massive trade deficit. In fact, it came out this morning. The latest monthly number is $100 billion trade deficit in 1 month, $100 billion trade deficit. So, people have whined about the trade deficit forever. It didn't matter. Why? Because globalization was expanding. Who cares? You're getting better and better quality goods for cheaper and cheaper prices as globalization expands. Who cares? Now the trade deficit says we're dependent on the rest of the world for everything, and globalization is starting to contract. So here's a simple way to think about it. Why does the U.S. government, why do investors understand the national security implications of being dependent on the world for semiconductors, but they don't understand the national security implications of being dependent on the rest of the world for everything? Everything. And that's the story of the U.S. economy. And the U.S. economy, if globalization is going to continue to contract, the U.S. economy is going to have to rebuild its independence, right? We're going to have to become more self-sufficient. That, we think, is a monster investment theme. This whole, you can call it the reindustrialization of America. You can call it reshoring, nearshoring, friendshoring, infrastructure, rebuilding the American capital stock. It's all the exact same theme. It's basically the rebuilding of the U.S. industrial infrastructure, and we think monster theme. So of course that's focused largely on things like industrials and that sort of thing. But here's a good way to think about it. Everybody knows that California has passed that law that by 2035, all vehicles sold in the state of California have to be electric vehicles, right? We could argue, is that good or bad public policy? Not my day job. I don't really care. But the reality is the California electric grid cannot support that. So is it a better investment theme to go buy electric vehicle companies, or is it a better investment theme to go by the industrial companies that are going to build out California's and modernize California's investment electric grid? At RBA, we're betting on those industrial companies that are going to build out the electric grid, modernize the electric grid. That's the simple way to think about this theme. It's all kinds of companies. They're in the industrial sector. Look, you're not going to impress anybody at a cocktail party saying that you've bought, America's largest producer of cable wire. It's just not, the grid. You're not going to impress anybody with that versus saying, "Oh, I just bought an electric vehicle company." It's like it's so sexy. But this is a critical part of this reindustrialization of America.
Do you like utilities long term as well?
Utilities are a little bit difficult because on the one hand, they could be part of this. On the other hand, we all know that they're very dependent on interest rates. And if deglobalization does hit, interest rates will go up. So you've got kind of an offset there. What you really need is for their basic business to start growing. If their basic business starts growing, I think utilities will do great.
Right. I'm also assuming that a lot of your reindustrialization story is going to require a weaker dollar. So, what are your thoughts on the dollar longer term?
Let me say, we don't forecast currencies per se. So I don't want everybody to think like, we make all these millions of forecasts and that's embedded. We really don't forecast currency per se. But that being said, we do think we're heading for a period of secular inflation, right? As globalization contracts, competition goes down, you tend to get more inflation rather than less. Now, that doesn't mean 8% inflation, but it might mean 3 instead of 2. But that may mean the Fed stays tighter for not just longer, but for like really longer than people are anticipating. And if that's the case, the dollar will probably be a little more stable than people think. The one thing I always point out to people is that we worry a lot about the dollar and the movement in the dollar. But if you look historically at the DXY index, which is the composite index, you'll see that the Treasury Department through time, and this is over many years, many different administrations, everything else, has stayed relatively stable. It's traded within a band. It's never like gone wild in one direction or another. And I would think we want to consider that the future as well.
Thoughts on commodities, gold, and other, let's say, metals, and yeah, let's talk about the commodity complex in general. In case you have,
Sure. So gold, we have in our multi-asset portfolios, and we do have one up on your platform. It's the IMGP Global Risk Balanced is a multi-asset fund that's up, and that does have gold in it. It's got probably usually have between say 2 and 4% or 2 and 5% in gold. Why do we do that? We're not gold bugs, and I don't believe anybody should like go get gold coins and bury them in their backyard or something like that. But gold is a good diversifier. It's a hedge against uncertainty. So that uncertainty could be inflation, it could be geopolitical issues, all these different things. And so it's a good ballast against volatility is the way to think about it. So we tend to have somewhere between 2 and 4% in gold. In terms of industrial material prices right now and things like that, they're very healthy right now. Again, the global economy is a bit stronger than people think. And industrial materials are not a good forecaster of the future of the economy, but they're a good barometer of where you are today. And they're cooking. Recently copper broke through $5, things like that. There's all these little hints that the economy is strong. So we do think that one should look at that. The other thing that longer term that one should consider is that various sources of commodities, let me rephrase this. If deglobalization continues, different sources of raw materials are going to stop. They're not going to be as prevalent as they were. And that's probably going to be a supporter to the price of a lot of industrial and even probably some agricultural commodities. You're seeing right now, not that I'm an expert in any of this, but I saw an article today that talked about orange juice prices going up because of problems in Brazil. So there you go. It's a weird one. It's weather related. I get it. It's not exactly what I'm talking about. But imagine if Brazil were cut off as a supplier of orange juice. It's a silly discussion that we're having right here. That's not going to happen. But think about that with copper. Think about that with oil. Think about that with all different things, that if sources of production are cut off and are no longer available to the United States, that obviously would support commodities. So I think commodities could be a much longer term growth story. If you believe the deglobalization, it could be a longer term growth story than people think.
Okay. And then final question, Richard, because we do have to go, unfortunately. I'll leave you with a softball question. Who's going to win the November election in the United States? And does it matter? How about that? That's a more interesting question.
So right? I have no clue who's going to win, no more clue than anybody on this call.
Of course.
Right knows. Question, who knows what's going to happen? We all have our favorites, one or the other, but realistically, none of us know what's going to happen. And I think that misses the point. And I think investors have become too myopic on Biden versus Trump. I think the bigger issue is not just here in the United States, but in many countries around the world, you're finding nationalistic tendencies are growing. Right, they're growing in Europe, some places in Latin America, right, in Africa for sure. You can see in Asia, different places, you can see the nationalism growing. my job is not to try to opine on politics. My job is to try to find the investment opportunity from the political winds, right? Whichever way it's going. Nationalism is pro-inflation, right? Because it's the opposite of globalization. And globalization got us secular disinflation, right? We could argue about all the different things. Is globalization good, bad? Not my day job again. But we know that opening markets, increasing competition puts downward pressure on prices. As you close markets, as you reduce competition, you should expect inflation to go up. That's what nationalism is all about. So good or bad, not passing judgment, the winds are kind of there. That kind of argues we're going to see more inflation rather than less. That's a big change that investors have to kind of digest. And I think that's much more important for portfolios than whether it's Biden or Trump. In my career, whoever loses, whatever party loses the presidential election says the market's going down, and we continue to have bull markets. Right. I mean, like, whether it's Reagan, whether it's Clinton, whether it's Obama, you can just go through on and on and on. Biden, Trump, all of them. Everybody said, the market's going down. No, we had a bull market. I really don't think that matters as much as people think. But the nationalism that's growing around the world is a sea change in the political environment that we have to watch very carefully. I would argue it's going to present a huge opportunity because portfolios are still positioned for secular disinflation. That's the way I look at it.
Yeah. So we certainly coincide on a long-term view on structural inflation. Richard, I'll leave you, or I'll give you the last word, final word you want to say to the audience?
Sure. So I neglected to name the two funds by name, but there is the IMGP Global Core Equity Fund and the IMGP Global Risk Balance Fund. Those are the two things, the two funds that are on your platform, both UCITS compatible, and we think we're a rarity in terms of how macro-oriented we are and the type of things we do. And we think it's got a place in everybody's portfolio.
Great, Richard. Well, thank you so much. Richard Bernstein from RBA Advisors, CIO and founder. Richard, thank you for joining us. Hopefully we can do this again sometime again.
Ahmed, great to be with you. Thanks for the invitation.
Great. Thank you. Bye-bye.
Insignia Financial Group LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services LLC, headquartered in Puerto Rico, and through Insignia Securities LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosures website, https://advisorinfo.sec.gov/.